What is up, everybody? Logan here again, joined with Halcyon and Trader for another video on our calendars. I recently just got a haircut, so I probably look a little different than what you're used to. But we're going to hop into a video. We got a couple things that we're going to chat about today, and we're really glad you guys have been liking the pos trading videos as well. So how you been doing, my man?
Doing great. Doing well. We are in the midst of creating an education 101 on how to defend and mindset and all that fun stuff on a trade that we're getting tested on right now. We need another 2 weeks before we can kind of walk through all the steps and what happened and how we adjusted and how it turned itself out and do we make profit, scratch, or a loss on it. So I think it'd be an interesting one to learn from when it's all done. So we're taking snapshots and pictures of it as we kind of, every couple of days so we can compare and show what's going on. And then, something that we talk about a lot is in trading, you learn the most from when you have a failure in your trading. And, winning is, winning's not easy. Winning also doesn't really teach you a ton about what to do when things go wrong in your trades. Yes, we want to have as often as possible, as easy as possible trades where you get in, like that Twitter one you had earlier last week. You get in, 2 days later, it's at 50%, and you get out. We want as many of those as possible. But inevitably, we're going to get tested at some point. And that's really where you have to hone your craft, is when you're getting tested, because it's sort of easy to say you're a wizard trader when everything just goes in the direction you're trying to deal with.
Yeah.
It's when it's not is where really you define what your make is or isn't with what you do in trading. It's just the reality, because the other way to view it too is that every single time you get a losing trade going against you, or a winning trade for that matter, the way that you interact with it, the way you emotionally deal with that on the winning or the losing, will be a little tiny accounting sort of in your brain as to how you're going to deal with it the next time it happens. And so if you have, an unhealthy responses to, like unhealthy emotional responses when trades go for you or against you, you're going to slowly build up this sort of immediate reaction that your brain's going to do, almost like a habit that it will create and trigger on you. And you want to be aware, like, are you creating habits or emotional patterns that are not going to help you at some point down the road with what your trading's doing? Because again, everybody can be a rock star for a month or two, or a couple of months, 6 months in trading. But, as the saying goes, there's old traders, there's bold traders, but there's no old traders. And it's true. Just if you want to be in this for a long, long time, that is the reality. Is you have to learn how to control your emotional spectrum, but also be really aware of when you are getting tested in a trade, what is going on inside of you. Because if you don't have that under control emotionally, you can't handle the pain anymore of being wrong or seeing upside down P&L or something along those lines, and you quit when you should be continuing to work your way through it, and refining your process, refining your emotional flexibility, so to speak. And it's the same thing on winning. Like, the problem we do on winners is we cut them short too fast. We get them out too quick because we felt really good that they were winning. And if you look at if you evaluate your trades every year, take a look at what did you do differently on your best winners versus the ones that were just meh winners. That's another aspect to hone in on your skills, is to get that figured out, and find out that little voice telling you all the time, what the FOMO voice is always speaking to you one way or another. So anyway, completely side thing. We will unpack and dissect the current trade that is absolutely testing us right now. And I'll kind of walk through my own personal thought processes. I've been in this trade, as well as, where I think I could have made some adjustments differently. We still have 2 weeks to go, so this may be a complete moot point, but it will serve as a good tool, I think, for learning going forward. With today's, though, we're talking about the single diagonal. And looking at how to utilize that in trading, and when we utilize the single diagonal. There's lots of varieties of doing these. They work similar to a calendar, except if you'll notice, we have a little tiny different shape here on our analyze function. So let's walk through our checklist of what we do, or at least how I do this, and then we'll get to this and to the diagonal side of it and make a decision of why we're doing what we're doing with it.
Perfect.
So, as always, we look at the charts, right? We're going to always start with what's going on with the VIX. Man, look at this, just creating the crater down here. That's a little up today, but you really, I mean, for all of the last year and some change, I mean, when's the last time we've been? It's been 2 years. When's the last time we've been this low? 2000 and early February 2020 is the last time we've been in this range where we are now. So it's been a good year and a month-ish before we've been below 18s. So as we look at this, when we look at the environments and we look at when you put calendars on, or diagonals still are affected by VIX, of course, but it's not as prominent as with a calendar. But with either one of those options you're going with, just you got to start where the VIX is. So don't want to do that when it's up in these top end of the ranges. I feel quite a bit safer when lower. Did I think we'd be in the hit 16 and a half? Heck no. I thought we'd be staying kind of stocked in the 20 to 22 range as this went sideways, but that's not been the case. So that's where we have to adapt. And also, a little nugget here is the most challenging times of trading is when you're transitioning volatility environments. Going from really low volatility to really high is usually a place where people get hurt pretty bad. And going from very high volatility to very low volatility is also a place where you find that if you get stuck in using the exact same strategy for every single environment, it's going to kick your butt at some point. You are going to get blasted by it at some point because doing strategies that work really well in low VIX environments obviously don't work very well in high VIX environments. Like doing some of our put credit spreads in a high VIX environment is just asking to get smoked at some point because the movement is so much bigger at those higher VIX readings. Anyway, so we look at this here now, very low reading here. I'm perfectly fine with this. I don't mind putting up calendars and diagonals when we're in this environment. I thought they were great at the 20s. I'm even happier learn the 16, 17s. Okay, less likelihood of us moving all over the map on us. And then we look at, of course, the instrument we're using on, which is the SPX. What is this? It's red. Haven't seen one of those in eons. But we look at the kind of daily view of this. And you guys know I like to use my standard deviation channels to help monitor this. Let me shrink the rest of this down a bit. Looking through here, we've had a absolute beast of a run from, let's hit this low. It was around here in March, yeah. So we got a little bit of a low here in March 23rd, I think, and we've basically been straight up from about a low of 38.50 to hit 41.30 this morning, which is insane that we've gone this far up without having any kind of meaningful anything. I'll say from the people around us right now, the traders that are around us, the FOMO is getting big time to the everyone get bullish and just go, it's going to the moon. I'm absolutely sensing that sentiment. I've had it expressed to me from a few different people who are kind of throwing in the towel of sideways to bearish. It's just going to go to the moon now, get out of the way. And then you have various reasons why that's the case. But what we know is we know how this ends at some point, which is this story's been played out a million times over. You get a really hard run up, and then it's as soon as everybody gets on the other side of the table, it's going to flush down pretty hard. This is just what usually happens in this. So being prepared for that, but also saying we've got to respect that the momentum continues to be up. So how do we kind of play both sides of that? And that's where the diagonal comes into play. Right? So the diagonal is going to give us an interesting way to play both sides of if it wants to drift up higher or if it wants to pull back. Okay, so then let's flip over to grab a diagonal. In this case, I'm looking at some different example here. The mean on my hourly charts is 40.77. Okay, so that's where I expect we do have a pullback. At this point, if we get to 40.77, hallelujah. It's a miracle, that we have pulled back a little tiny bit here. And that's where I would expect that to go. Now, what it's been doing is going from top channel to bottom channel. And that'd be 39.90, but that seems like a ridiculous thought that it's going to drop all the way back to the 3900s at this point. That's just how the FOMO feels at this point in time. All right. So, great if that happens. We're prepared for it if it happens. But right now, I'm expecting maybe 40.70s to probably be that kind of range where it's going to hang around there for a minute and then bounce back up. So we had a ton of resistance at 40.85. That was our big overhead. So that's going to act as support now as we move forward until it doesn't. So anyway, looking at that 40.77 kind of target would be the low end. Looking at the top end, gosh, man, maybe 41.70. You know, it's going to be top of the yellow channels here. We're already kind of over the top of it on the daily, and you're probably close to that on the middle time frames, 41.50, 41.70. So with that in mind, VIX is low. We're at the top end of the price channels. Momentum continues to be up, but it's not going to keep going up indefinitely. So how do we, you know, kind of participate a little bit with what's going on the upside, but be mindful of that it could pull back at any point right now, which is what usually happens at the top end of the channels. That's where the single diagonal comes into play. So here's what it looks like. Okay. It's a bit of an odd thing to think of it through this way, because you can structure diagonals in such a way that you actually get paid a credit to open a debit, which seems really odd when you think about that. Is this is a long trade. It's green, it's long. I'm not selling it. I'm going long, but by the way that the options are currently priced, my short dated, the ones that I'm actually selling versus the long dated ones that I'm buying, the shorts are more expensive than the longs, and thus it creates this credit, okay, which is kind of a cool and interesting way to play that scenario we just talked about, which is viewing the charts and saying, okay, what are the chances that we're going to go up and down from here? Maybe keep drifting up. And so if I want to participate with that, I want to have some upside movement. Well, I don't have any win. We potentially would do that if we set one up at the top. So if we go back over here, what's this do? It creates us a 40-cent credit on this position. This is a 41.80, 41.70 for April 26, April 23 diagonal. And so what that means is that we can't lose anything. In fact, we get paid 40 cents a contract for if this thing goes from here and stays anywhere below basically 41.20 for the next 2 weeks, which is a pretty sweet way to view that. Yeah. Now, from the profit and loss perspective, you have kind of two interesting things that you're dealing with here, which is we set it at 41.70 to be the middle part of our kind of mountain peak here. And if price wants to drift from here up to here, especially in the week of expiration, we're going to see this credit that we got paid will turn into a pretty nice long debit. Okay, which means you got paid a credit and then you get to get out of it for a debit, which is pretty sweet. Yeah. And that's best of both worlds there. Nuts. Right. Now, of course, what are the risks? There's always risks in all of these things that you're dealing with. The risk is that we just keep ripping and ripping and ripping and ripping and ripping, and we go above 41.90, get to the 4,200 almost range in the next 2 weeks, which it really seems like that's unlikely. But I would have said the same thing 2 weeks ago, that we'd be sitting up here near the 41.30 range when it was 4,000. I mean, actually, we were looking at like 39.50, saying 4,000 is a magnet. It's psychologically going to be the number we want to push to. And so, sure, we'll hit that. We'll probably pause and we'll have a retracement for a minute. And of course, we just went right through like it wasn't even there, which has just been very interesting watching the market do that. So this gives us an opportunity for 2 weeks to give ourselves 50 more points to the upside, which I believe the expected move this week is 50 points. Or if it goes down at all, we don't care because we're getting paid a credit and we can't lose any money on the downside, which is sweet. That is awesome. Okay, so this allows me the ability to play both sides of this. Again, thinking that maybe push a little higher. And then as long as we stay really under 41.70, I really don't care how far it pushes up, as long as it stays there. And anything else below that, looking great. Now, 2 weeks ago, I think on one of our videos, we showed an example of a diagonal that we had opened. This was a long debit diagonal. I think it was $1.75 to $1.85 at that time. And it was the same kind of thing. I think we opened it up on a Thursday, and then we closed it on the following Friday on the day of expiration. And that one was a 41.10, 41.20, I think, diagonal. It was not a credit variety. We were close enough to the money and the way the options were priced at that point that we had to pay a long debit to get into it. But we closed that at, I think it was, people were getting in from $3 to $3.50 if you closed it in mid-morning. Yep. And it ended up on the day closing up at $8. So, I mean, that was an awesome 200 to 600% return for holding it for 5 days, depending on when you decided to close on that Friday of expiration. I know that the calls we were giving, I think we said $3.50 when it was at that price at that time. And a lot of people got from 3 to 350 on that. So
we were
that's what this can do too. So we can see this turn into about a $6 debit in that range, maybe an $8 debit, depending if the VIX wants to pop up a little bit too, which would be a little bit odd for that to do that in this type of structure here. But you just never know. The VIX does weird things sometimes, like being up today when it's barely down. But whatever. At this point, the VIX is its own beast, does its own thing. So this is our kind of current trade. I'm really liking what this looks like. I like how this is structuring. We have another version of this, which we'll get into, that we did 2 weeks ago at this point, or a week and a half ago, that has been nothing but we blew through the other end of this, right? We're way up here now where the original one was set. And so that's the one we're going to walk through. How did we defend this? What did we do to offset our upside risk? And then, we'll kind of get through the mindset of what's going on when the trade goes against you. Because again, the reality is managing yourself when the trade goes against you is probably the most important thing you can learn to do early on in trading. The wins will take care of themselves, and you can eventually hone the craft of how do you let your winners keep running. But it's the trade going against you is probably the most difficult thing initially to really master and get yourself in a mindset to properly handle that and be ready to go when that does take place, because it will happen. I don't care what you're trading, put credit spreads, straddles, strangles, whatever. At some point, you're going to have a trade that doesn't do what you expect it to do. And how are you going to handle yourself when that takes place? And that's I like personally doing, if I do a lot of diagonals, a lot of calendars, butterflies, is because they give me a lot of outs that are more than just roll it up or just take my losses and walk away. And I'm hoping that the current example we have going in the current trade is going to give us an opportunity to show what all that looks like. So we're documenting as we go through this. I'll take some more snapshots over the next 2 weeks of what everything looked like on the graphs as we get closer to that, and then we'll dissect it as to why we were doing what we were doing on it and how we defended, and all that kind of fun stuff. So any questions from you, Logan, on this one?
No, everything's great.
Cool. So the expectation wise, you got to defend if you rip past the short strike, which is 4170 for us. You got to do something. Usually you can add on more diagonals. You can add a calendar into there. A lot of that's all dependent upon how much expiration you have left to go. I feel pretty solid about where we are with this particular setup based off of where I am on the charts, right? Again, it's only been essentially, I think maybe once in the last 2 years have we been at the top of the channels like this, maybe twice. And every time you see a nice little pullback. Something to also be aware of, the average true range for which the SPX moves is at 3 standard deviation move as we speak right now, which is whenever you hit that far away from the average true range, it rarely stays there. So at best, it goes sideways for a long time, or what normally happens, you have a pretty good retracement, usually to wherever the prior support was, which in this case is going to be around 39.90s again, which is actually kind of funny. That's somewhere at the bottom end over here. So yeah, that's typically what takes place. Again, markets can be irrational longer than you can stay liquid and solvent in your accounts. So you got to be prepared just in case that is the case. But that's how we're approaching this right now. And that's what I'm seeing in terms of how I would be from a, I'm optimistically, well, I would say I'm a cautiously bullish right now that it might keep drifting a little more before we pull back. I'd be very, very cautious about, going whole hog in here right now. This does not seem to be a really good risk reward, is getting super bullish right this second here.
Right.
So be very cautious how you decide to approach that, which that's how the diagonals can do that. Be cautious up to about 4170. And if it sells off, oh well. This is like I said, my goal here is this is a low risk type of play for me. Yeah. My goal is not to make a bazillion dollars off this trade. It's just to give me some upside potential, and if I'm fine, I'll take a 40-cent credit on each contract and move off to the next one. So there you go.
That's huge. And no matter how far it falls, you'll still get your 40-cent credit.
Right. You potentially get even more than that, because again, if VIX goes exploding, this will push this up a little bit. But no, at worst you can do is a 40-cent spread on this.
Wow.
This is an interesting way to play credits in general. Diagonals give you that. Again, here's one thing: you have margin you have to deal with too, right? Anytime you have credits, you have margin you're dealing with. Yep. So there's a collateral, so to speak, there. But this is an interesting way if you have let's say you want to do a put credit spread on a stock, but you don't know for certain that it's going to actually go down. You can always figure out how to do that, right? I mean, you can always flip things around, adjust the calls and puts. I mean, you can always do something like this if you feel like, I think this is probably entry for a put credit spread, but I want to give myself a little bit of room to be wrong on this before I get tested on it. This is another interesting way to do that. So as you start exploring the diagonal world and the credit version of the diagonal worlds, really what you're doing is you're going to play with the distance between where your short strike is and your long strike. So, if we, for example, let's say it's 41.70 right now. If I made this actually below it, 41.60, notice how different I look now on my chart, my setup here.
Yeah.
Sorry, I got to unlock that. Now it's 5.95, and it's actually flip-flop the other way around. So now, I'm going to lose if I go down, but on the upside, I can't blow through anything that I'm doing here. I'm going to make my best case here, which is about $7,000. So
wow.
I normally will use these as a variety of doing them as a credit, which we'll go back here, which was 40 cents what we got for this one.
That's awesome. And how much would you scale into that position with? Just your normal 10 lot size?
On this one, I would do it. I would do whatever your basic position is. So again, if you're looking at 5 to 10% in a single position, then do 5 to 10% of this, no problem. I mean, it's cool. It's really the thing about, it's like a $5,000 trade because you got that $5,000 margin you're dealing with there. So if you're like, 10% of what you put in per trade, do 10%. I always leave money on the sidelines, at least 25%, but most of the time 50% of my account on the income trades is sitting at that account that's designated for that. It has about that amount sitting always in the sidelines for defending a hand you need to defend. Like I said, because it's a portfolio that's sliced into multiple portfolios. That piece of the pie is always set up like that.
That's great. So there you go. Well, I appreciate it.
No problem, man. And your shaved off head there looks great.
Dude, I donated 4 ponytails worth today, and
awesome.
It was actually a little shorter than I expected it to be, but I was like, let's roll with it. It'll always come back, and I can start the process over again. So
yeah, when you do your little image on your thumbnail with you pointing at whatever thing you're pointing at, you're gonna have we're gonna know if it's a new one or not because you got the short hair.
Yeah, I can't use any of the old pictures anymore.
Nope, gotta do some new ones.
Yeah. Well, is that everything you want to cover on this video?
Yeah, I think so. So let's just real quick, super fast, watching this one. Check your VIX first. Where is it? It's really low. Check like that. SPX. Take a look in the field. Playing field. Where is that currently? I think that's on the top end of the nosebleed section of the playing field. So a logical thought process would be you'd have a sideways to slightly down market from here. Then we look at what are the options that we can play with here. We can do a calendar. You can do a diagonals. I mean, you can do whatever you want to do, obviously. In this case, if we're talking about calendars and diagonals, I like the diagonal here because it gives me a credit if we go down, and I get some room to the upside if we can just move up and up and up. And then finally, from a capital, take whatever your normal position is, 5 to 10% on any position. And like on the income side, I eventually will have that account will be upwards to 50 to 70% of the account is in versions of these things all at one time. But most of the time, one's expiring every week, so it's rarely staying at that amount.
Right.
Every single week. It's usually one falls off, and I'll look at adding another one on, and just continue that process over and over again. So, awesome. And there you go. And then just leave money on the sidelines to defend. You always got to have money to defend these things.
Yeah, that'd be tough being in all on one play, and then you can't defend it.
Well, yeah, I think we've had a couple of people who've, and maybe I probably didn't clarify this as well as I could have, which is, to be clear, I'm not taking a single version like this and then putting 70 or 80% of my account in one of these things. I should be clear that it's a collection of these all going at the same time where I will be upwards to 70 to 75% of these. I know we definitely had a few people ask,
yes,
hold on a second, you're putting 75% of your account in one position? No, I would never put 75% into one position unless I had a crystal ball that guaranteed me something. Then I'd probably do like 90%. So.
And that was another question that I'd gotten too, because someone asked how much of my account was I in this trade with, and I said about 5%, 5 to maybe even 6 at the point when we started defending, right? To
Yep.
where I scaled it up a little bit, and that was after the defense had been added. So about 5 to 6% after defense was added. So that could have been 3% roughly, that I was in like that specific play with, and just for my personal right risk and what my reward was. So that's the other thing too. It wasn't like I was in with, hey guys,
Yeah, 50% of the
25%.
account in one position. Yeah.
Yeah, like hey, 50% of the accounts in this specific leg in, right? It's like now we gotta defend it. So yeah, no, it's a good thing to clarify for sure. But I totally knew what you were saying out of the gate. But I know a lot of other people who were confused. I've
Well, I
seen,
mean, think about our attention spans these days. We're probably, it's somebody's probably watching the video, but also doing three other things at the same time. They're just kind of catching little
yeah,
blips of it here and there. But yeah, don't put your entire account into one of these. That's not a good idea. It's not a good strategy for literally anything. So don't do that. And then if you do, don't come complaining to us that you did that. So that's on you.
and if you're driving in the car right now, honk the horn for Halcyon Trading.
Beep beep.
Well, I really appreciate you coming on for another video, and we'll have you on again in the future. We can chat a little bit more about these, but I've been really pumped with how the calendars have been, especially the diagonal play. That was fantastic. The last
Yeah, that was a
one we had.
nice win for everybody.
Because
it's fun to have those.
that was when I was only in it for 2 days, Tuesday to Thursday, and
Nice.
it was fantastic.
Oh, that's right, because we had that on that Tuesday. We got another opportunity to buy
Yeah.
more if you wanted more of it for
Yeah.
that same price.
So I was like, all right, and I always, I picked up a few.
No, I'm sorry, that was a buck. That was right. It was a $1.05 or a $1.10.
Buck
That wasn't
$10.
$1.85. It was a $1.05. That's right.
It's a
And it
good
sold
trade.
finished up for $3.30 to $3.50 for most people, but it went all the way up to $8 by the end of that day, which was awesome. That was
Wild.
that was a nice win for anybody who held on that long. I wasn't holding that long. I took the 200+% and walked away.
Said
But
peace out. No, it's
all right, man.
Cool.
Good chatting.
All right. See you in the next video, man. Thank you guys for making it this far. And if you guys could leave a like, consider subscribing, and a comment below. And if you made it this far, comment a emoji. Any emoji.